Welcome back to Curious Commerce, Working Capital Management, continuation from part 8. The first sources of working capital is the trade credit. Imagine this situation. You start a small shop, you don't have much cash, but you go to a wholesaler, pick stock worth around 50,000 rupees, and the wholesaler says pay after 30 days. For that worth of 50,000 rupees of stock has the nature of no loan. It is not treated as a loan. It is not borrowed from the bank, and the internet is not necessary for that, right? Still, you got stock. This this is not luck. This is called trade credit. And this one concept is the backbone of small businesses. Today, let us clearly understand what is trade credit, how it reduces cash outflow, why it is common for small businesses. Simple, practical, real business understanding. Trade credit means buying goods or services now and paying for them later. It is supplier provided finance. For example, retailer buys goods today, supplier gives 30 days time to pay, that is credit period. Retailer sells goods in the market, retailer collects the cash from the customer, and retailer pays suppliers later. So supplier becomes like a temporary financier for the retailer. No paperwork, no EMI, no internet, just trust and business relationship. That's why trade credit is the most natural form of working capital. Supplier credit, the real meaning of trade credit. Trade credit exists only because of suppliers' trust. Suppliers gives credit when buyer is regular, payment history is good, relationship is strong, and business volume is steady. In many markets, suppliers offer terms like 15 days credit period or 30 days or 45 days. Sometimes up to 90 days they are given the credit period. For example, a medical shop buys medicines daily, distributor gives 30 days credit in general. So medicine shop runs entire month using suppliers' money. That's why trade credit is called suppliers' credit. In reality, thousands of businesses survive only because of supplier support. Trade credit reduces immediate cash outflow. This is the biggest benefit. Without trade credit, shop must pay cash immediately. Cash gets exhausted quickly. Business growth becomes slow. With trade credit, stock is purchased without paying the cash now. Goods are sold to customers. Money is collected and supplier is paid later. So business enjoys a cash flow advantage. For example, you buy goods worth rupees 1 lakh on 30 days credit period. You sell those goods within 20 days and collect 1 lakh 20,000 rupees. You pay suppliers just 1 lakh rupees on 30th day. You still have 20,000 rupees surplus. This is smart working capital management, right? Trade credit always allows business to rotate money faster, grow without big investment, reduce dependence on bank loans. Why trade credit is common for small businesses? Small businesses usually face limited capital, no strong bank access, less collateral value, and cash flow pressure. If small businesses opt for financial assistance from bank demands documents, banks demand security, banks analyze history, and banks demand for the guarantees. But suppliers demand only one thing, that is trust and regular payment. That's why kirana shops, mobile shops, garment stores, hardware shops, pharmacies, and small factories all depend heavily on trade credit. For many small businesses, trade credit is not an option, it is a survival. So remember three powerful truths about trade credit. It is supplier's credit, not bank credit. It reduces immediate cash outflow. It is the lifeline of small businesses. Trade credit is invisible finance. No agreement, no internet, but huge impact. The business person who manages trade credit wisely can grow even with limited capital. Imagine the situation. Your businesses need money today, but next week you will receive customers' payment. So you don't need a big loan, you just need temporary support. You go to bank and bank says you have overdraft and cash credit facility. You use money when needed. You return when cash comes. You pay interest only for usage. This is called smart borrowing. Today, let us clearly understand what is bank overdraft, what is cash credit, why it is flexible, and why interest is charged only on usage. Shall we discuss one by one? Overdraft and cash credit both are working capital facilities provided by banks. They are not like fixed loans, they are like a financial safety cushion. Banks gives a limit, for example, rupees 5 lakh on OD limit, rupees 5 lakh on cash credit limit. You are allowed to withdraw money when needed, deposit money when available, use again and again. So it works like a business current account with extra power. Flexible borrowing, that is the biggest advantage of OD and CC. In normal loan, you take full amount, EMI starts immediately, and interest on full amount. But in the case of OD and CC, you take only what you need or how much you need. You return when cash comes. You can borrow again and again. For example, bank gives OD limit of 5 lakh rupees. Day 1, you use 1 lakh rupees only. Day 10, you receive customer payment, you deposit 1 lakh rupees to that OD account. For 20th day, again you need 2 lakh rupees. You have the chance to withdraw again. This flexibility helps business to handle ups and downs, manage daily expenses, pay suppliers on time, and avoid cash pressure. That's why OD and CC are called running finance facilities. Interest only on usage, not on full limit. This is the smartest part of OD and CC. Suppose OD limit of rupees 10 lakh, but you used only 2 lakh rupees. Then interest is charged only on 2 lakh, not on 10 lakh rupees. If tomorrow you deposit money and outstanding became rupees 50,000, then interest is calculated only on 50,000 rupees. So, less usage, less interest, more discipline, more savings. This encourages businesses to use money only when needed, return quickly when cash comes, maintain financial discipline. OD and CC reward smart cash management. But what is the difference between OD and CC? The overdraft is linked to current account, but cash credit is linked to working capital account. That is the basic difference. OD is for common for service and traders. Cash credit is common for factories and large traders. OD is based on account turnover. Cash credit is based on stock and receivables. But both OD and CC has the flexibility. But purpose of both is same. Smooth working capital flow. So remember, OD and CC provide flexible borrowing. You can withdraw and repay anytime. Interest is charged only on amount used. They help business survive cash fluctuations. Smart businesses do not fear bank facilities. They use them strategically. Bank overdraft and cash credit are not danger. They are tools. Used wisely, they become powerful growth engines. Thank you all. For daily updates, follow WhatsApp channel Curious Commerce Financial Management Hub. The topic working capital management will be continued in part 10. If you like this type of the videos, subscribe and share. Thank you all.